What sparks fly when machine learning meets trading? The Dr. Janker strategy cleverly introduces multi-kernel regression from machine learning into financial quantitative trading. This technically advanced innovation is changing the game rules. Hello everyone, welcome to the Inventor Strategy Selection channel. This channel is dedicated to screening the most classic and cutting-edge mature strategies in the crypto field. In recent years, machine learning technology has developed rapidly. Among them, multi-kernel regression as a popular theory has shown good results in data analysis. Many quantitative traders are starting to think, can we apply these emerging machine learning theories to crypto trading? Traditional technical analysis, although classic, often seems somewhat single and lagged when facing complex and volatile market environments. The Dr. Signal strategy is a positive attempt under this thinking. It combines multi-kernel regression technology with traditional dynamic support and resistance systems, exploring the application possibilities of machine learning in actual trading. This strategy has quite high technical content and is quite innovative. It provides us with a valuable case to observe how machine learning theory combines with quantitative trading. The core highlight of the Dr. Janker strategy is the attempt to introduce the currently popular multi-kernel regression theory into quantitative trading practice. Multi-kernel regression is a relatively mature technology in machine learning. Its basic idea is to better fit data patterns by combining kernel functions with different characteristics. In this strategy, two classic kernel functions are selected for combination: Gaussian kernel and Epanechnikov kernel. The Gaussian kernel uses a normal distribution weighting mechanism, giving higher weights to recent price data, making the model more sensitive to the latest price changes. The Epanechnikov kernel uses a parabolic weight distribution, providing good statistical properties while maintaining computational efficiency, making it more suitable for capturing medium-term trends. By adjusting the alpha parameter, you can find the right balance between these two kernel functions, allowing the model to respond to short-term fluctuations while maintaining a grasp of long-term trends. Another innovation of the strategy is the dynamic reactor system. This design gives traditional support and resistance lines a certain adaptive capability. The system dynamically adjusts boundary positions based on price breakthrough situations, avoiding the problem of fixed horizontal lines being easily misled by false breakouts. At the same time, the strategy also integrates RSI filters to avoid wrong signals in extreme market conditions, and adopts dynamic stop-loss and batch profit-taking fund management mechanisms. The entire system forms a complete trading loop, from signal generation to risk control, all carefully designed. The parameter design of the strategy reflects a deep understanding and precise control of market dynamic characteristics. The default quantity value equals 10 sets the default opening position to 10 lots. This parameter needs reasonable adjustment based on different trading varieties, price levels, account capital size, and personal risk tolerance. For high-value varieties or small capital accounts, the lot size should be appropriately reduced. The ATR length parameter controls the dynamic reactor sensitivity to market volatility changes. Shorter periods allow the system to sense market state transitions faster, ensuring resistance and support levels can respond to price changes in time. The SMA length parameter determines the calculation basis for the price center, and coordinated cooperation with ATR length ensures the internal consistency of the entire dynamic resistance support system. The ATR multiplier parameter is the core regulator of system sensitivity. It establishes a precise balance between filtering market noise and capturing real signals. In the multi-kernel regression module, the regression period parameter provides sufficient data samples for the machine learning algorithm. This parameter needs to find the optimal balance between computational complexity and prediction accuracy. The Gaussian band and Epanechnikov band parameters respectively control the smoothing degree of the two kernel functions, directly affecting the fitting quality and response characteristics of the multi-kernel regression model. The Gaussian kernel weight parameter realizes intelligent fusion of the two kernel functions. By adjusting this weight, the strategy can show the most suitable characteristic combination in different market environments. The construction of the dynamic reactor demonstrates the core mechanism of the adaptive resistance support system. Unlike traditional static support and resistance lines, the dynamic reactor has intelligent memory and learning capabilities. It dynamically adjusts support and resistance positions by real-time monitoring of the relationship between price and boundaries. When price breaks upward, the system remembers this breakthrough and correspondingly raises the upper rail position, ensuring that subsequent small pullbacks will not trigger wrong sell signals. When price breaks downward, the system lowers the lower rail position, avoiding false buy signals from short-term rebounds. This dynamic adjustment mechanism allows resistance and support lines to truly adapt to the development rhythm of trends. The multi-kernel regression module is the machine learning core of the strategy, realizing direct application of advanced algorithms in trading strategies. The Gaussian kernel function uses a normal distribution weight allocation mechanism. Through exponential decay functions, recent prices have higher influence, making the model acutely sense the latest price changes. The Epanechnikov kernel function uses parabolic weight distribution, providing excellent statistical characteristics while maintaining computational efficiency. When these two kernel functions with completely different mathematical characteristics are fused through weighted averaging, they create an intelligent regression model that has both local sensitivity and global stability. The signal generation module reflects the important role of multi-layer filtering mechanisms in modern quantitative trading. This design concept comes from ensemble learning ideas in machine learning, improving decision accuracy by combining multiple different judgment criteria. When the multi-kernel regression line crosses above the dynamic reactor line, the system detects a technical breakthrough signal, but at this time, it will not immediately trigger trading. Instead, it will further check the RSI indicator status. This dual verification mechanism design is based on an important market observation. The most reliable trading opportunities often appear when technical breakthroughs and market sentiment indicators simultaneously give confirmation signals. The RSI less than 70 condition ensures buy signals will not trigger when the market is overly optimistic, avoiding the risk of chasing highs. Correspondingly, the RSI greater than 30 sell condition prevents blind following and panic selling. This multidimensional signal verification mechanism not only improves trading signal quality, but more importantly, it reflects the strict requirements for risk control in modern quantitative trading. The strategy execution module realizes perfect combination of modern risk management theory with dynamic adjustment mechanisms. Unlike traditional fixed stop-loss methods, this strategy uses dynamic risk calculation methods based on market volatility. The theoretical foundation of this method comes from modern portfolio theory and behavioral finance. The risk value is dynamically defined as the distance between current price and the dynamic reactor. This distance reflects the reasonable volatility range under current market conditions. The wisdom of this design is that it synchronizes each trade's risk exposure with the current market's actual volatility level. It will not be shaken out by normal volatility due to overly tight stop losses, nor will it bear unnecessary risk due to overly loose stop losses. The exit strategy uses layered management methods, widely applied among institutional investors. First, set fixed profit-taking levels, lock in 50% positions basic profit, then manage the remaining 50% position through trailing stop mechanisms, maximizing profit potential in trending markets. This design achieves mathematically optimal balance between protecting profits and giving price fluctuation space. The visualization system design fully considers the efficiency and intuition of human-computer interaction. The Dr. Janker strategy transforms the calculation results of dynamic reactor and multi-kernel regression into easily understandable visual information through color coding and area filling. Green and red trend indicators not only conform to traders' traditional cognitive habits, but more importantly, they can quickly convey the system's current state judgment. The filled area between the two core lines creates a dynamic trend background, allowing traders to intuitively feel the strength changes of market momentum. Signal markers use simple geometric shapes rather than complex indicators, ensuring clear identification of key trading points even in dense price fluctuations. The alert system implementation considers the characteristics of modern trading environments, ensuring important signals will not be missed due to human factors through programmatic notification mechanisms. The Dr. Janker strategy, as an innovative combination of multi-kernel regression theory with dynamic resistance support systems, shows obvious environmental adaptability characteristics in practical application. The strategy's machine learning core makes it particularly suitable for handling market data with complex patterns. The combination design of Gaussian kernel and Epanechnikov kernel can automatically adjust response characteristics in different market cycles. In clear trending market environments, the dynamic reactor system can effectively track price trajectory changes, avoiding being misled by normal pullbacks and exiting too early. In oscillating markets, the dual kernel regression model can find balance between capturing short-term opportunities and avoiding frequent trading through fine adjustment of alpha weights. It is important to note that as a machine learning-driven strategy, Dr. Janker has high requirements for data quality and market liquidity. In environments with insufficient liquidity or abnormal data, model prediction accuracy will significantly decline. Additionally, while the strategy's RSI filtering mechanism can avoid wrong signals under extreme emotions, it may miss some effective trading opportunities in rapidly changing markets. The key to successfully applying this strategy is understanding its machine learning nature, adjusting kernel function parameters based on statistical characteristics of different trading varieties, and regularly evaluating the model's effectiveness in current market environments. The Dr. Janker strategy is a positive attempt to introduce machine learning multi-kernel regression theory into quantitative trading, shows good balance in both technical innovation and practicality. Strategy completeness performs excellently. From multi-kernel regression models to dynamic reactor systems, to layered profit-taking mechanisms, The entire trading process logic is clear with good module coordination. Risk management adopts dynamic adjustment mechanisms. The adaptive stop-loss design based on ATR can adapt to market volatility well, though there is room for improvement in handling extreme market conditions. In terms of adaptability, the alpha parameter provides flexible kernel function combination methods. The dynamic reactor also has certain market adaptation capabilities. Parameter optimization requires some understanding but is not complex. Understandability as a machine learning strategy is acceptable. Although multi-kernel regression sounds advanced, actual application is not hard to understand. This also opens the door for more machine learning theory applications in quantitative trading. Innovation is the outstanding highlight of this strategy. Combining Gaussian kernel and Epanechnikov kernel for price prediction is interesting and inspiring for thinking about what other machine learning methods can be introduced to trading strategies. Practicality performs well. The strategy shows stable performance in trending markets with good signal quality. It is a good example worth learning and improving. This exploration combining traditional technical analysis with modern machine learning deserves encouragement. I believe more similar innovative strategies will appear. Everyone can conduct deeper discussion and improvement based on this thinking. We also welcome everyone to explore and try more on the Inventor platform.